Hello and welcome to this MF Corner special. I'm Pavitra and today we're going to talk about how you can effectively study mutual fund returns and more specifically why looking at the 3-year fund return is just not enough. It can in fact be hugely misleading. I have Kirtan Shah, founder and CEO at Credence Wealth Advisors, who's joining me now for this chat. Kirtan, you'd written a short piece on this a few weeks ago, and I realized that we haven't spoken about this very important topic. So we often talk about how, the past returns of a scheme are not reason enough for you to invest, but the truth is that we do see this happening a lot, and a lot of investors will look at the past returns, pick the one which has done the best and just go for it. So take us through why looking at just the past 3-year returns is advised against. And, of course, the first would perhaps just be that it does provide a bit of an inaccurate picture. But illustrate that for us.
Pavitra, thank you so much for having me on the show. I think this is extremely important as a point to discuss is because unfortunately, a lot of investors that we meet in general or otherwise also, I've seen this as a very, very common mistake that everybody makes. Because while there are 1,700 schemes available and you intend to invest in 4 or 5 schemes, the easiest way for people who don't really spend so much of time and energy and don't do this as a full-time work, for them to pick 4 or 5 funds is just to look at the last 3 years of returns. And whichever scheme has given higher returns, you invariably aim to pick that up, assuming that those are the best kind of funds that you really want to invest in. But that's extremely counterproductive, right? Is because when you just look at the last 3 years of returns, there are so many things that you miss out on. You have absolutely no idea what risk was taken to generate that kind of returns. You have no idea of why those returns were generated. There can be very specific reasons why those 3-year returns look very interesting, but has not been consistent enough. You've not typically looked at the risk-adjusted return of the product and just looked at the return. So I'll give you a couple of examples. Let's say if you look at the last 3 years and hypothetically assume that this year your fund has made 30% profits, but the last year the fund made only 7% profit, and the year before the fund lost 4%. Now, typically when you go on to these websites where you try and compare funds, those websites typically show you 1 year return of the fund, 3-year return of the fund, 5, 7, and 10-year returns of the fund. Now, invariably what happens is when your immediate year returns are very good, suddenly everything starts looking good. The data that I shared with you, in that data, you would see that 1-year returns will be shown as 11% and 3-year returns will be, 1-year return will be shown as 30% and 3-year returns will be shown as 11%. Now, invariably, you start thinking that the fund has been extremely consistent, right? But the fact of the matter is that when you look at 11% in the first year, 11% as CAGR for 3 years, that will give you an impression that the fund is consistent, whereas that is not exactly the fact. So typically what everybody has to understand is when you look at point-to-point returns, Pavitra, your last 1 year returns actually make your 1 year, 3 year, 5 year, 7 year, 10 year either look very good or either look very bad. In the case that we were discussing, because the last 1 year return was 30%, suddenly your 1 year, 3 year, 5 year, 7 year, 10 year will start looking good. But if let's say your last 1 year is bad, suddenly the same numbers will start looking bad. So looking at the last 3 years numbers actually don't give you any idea of how consistent the fund was, how much risk was taken to generate that return, and what was actually the reason why those returns got generated.
Oh, absolutely. I take your point on that. Kirtan, just building more of the same piece that you had written and shared with all of us, is that very often we get this query also from investors that, that want to get into mutual funds saying that I saw XYZ sector was doing very well, so I decided to get in, and ever since I got in, it's doing nothing. So your thoughts on this, and how do you think you can avoid this as well? Because it happens to many people and perhaps the best of us.
So Pavitra, again, you would see all of these sectors go through cycles, right? In any market situation whether you are in a bull market or a bear market, there are always going to be some sectors which will do better than the other sectors. Now, when you filter funds basis the last 3 years of return and whoever's generated higher returns and you end up selecting that, you will typically invariably come across highest number of recommendations that will come to you of sector or thematic funds. Because let's say the markets are not doing well, your diversified funds may not do well, but in the same cycle, you might have one or two sectors which would have done really well. So suddenly those sectors start showing to you as very good funds in terms of performance. And again, as investors, we end up making the same mistake and invest in those sectors. What we really have to understand is that sectors are cyclical. So you will see most of these sectors work for 2-3 years, then they will have a dull 2-3 year period, and then they will have another 2-3 year period depending on macros and interest rate cycles and all of it. So if you look at the last 2-3 years of sector performance and you invest, invariably you actually invested at the peak of the cycle in the near term. And as soon as you invest, the downward of the cycle starts and you will see an unhappy performance from the same sector over the next 2-3 years. And which is why I think it's extremely important that investors understand that while you are trying to do sector investing, you should typically look at the last 3 years of investments of sectors which have not done well and try and invest in those sectors, because those are the sectors which will come for an upcycle and you will get a larger advantage in terms of doing better investing, rather than looking at sectors which have actually performed and invest in that. That's one. And second, there is a big risk in investing in sector funds, right? Is because you are not diversified. You're putting all your eggs in one sector, and if something goes wrong with that sector, you don't have anything else to balance that. So I think you should only do sector investing probably when you understand investing, you are a sophisticated investor, and very specifically, you know when to exit from these funds.
Yeah. Okay, got that. And Kirtan, very important to point out. And also, the thing is that very often when you start hearing about a sector doing very well, it's already run up a lot, right? So, which is why we often mention that the returns that an investor sees versus what the fund sees are often very, very different. But the same thing that you mentioned about, how sectors move in cycles or themes move in cycles, the same can be said of investment styles as well. Would you recommend really getting into, studying the investment style of a fund manager before you put in money?
Pavitra, I think it's extremely important, and I'll tell you why. Look, largely, we will see that there are three large styles of investing that fund managers would typically follow. One is growth style of investing, one is value style of investing, and one is momentum. Now, you will see that all these three styles work in cycles again. Now, if you look at the last 3 years of performance, you will invariably see that the top 5 schemes that you will end up selecting would be following one set of cycle or one set of style of investing, right? But while you're trying to bring together a portfolio, right, just adding more schemes won't really help you diversify. What ideally, in my opinion, you should typically be doing is get a large cap, mid cap, and a small cap, all three exposure, and make sure that while you're trying to put those 4-5 schemes together, you have one scheme which is doing growth investing, another doing value, and another doing momentum. What this will do is at any point in time in the market cycle, you will have either of these performing. So sometimes you will have a large value performing, sometimes you will have small, mid, and momentum performing. So if you diversify your portfolio like this, then your portfolio will actually be diversified in the true sense, rather than just adding more schemes to your portfolio and assuming that you are diversifying.
Oh, I completely take your point on that. It's sort of covering all your bases, right? Making sure that you don't completely are on the low end at any given point. Kirtan, we've discussed a lot of the things that you should not do, right, when you're studying returns. Take us through what is a good and effective way to be studying returns that any scheme would have generated.
So, Pavitra, that's a very interesting thing that if investors understand, they'll be able to do a lot of good for themselves. Yeah. What you ideally look at in terms of returns is rolling returns, right? So what is this data point? Rolling return is ideally a data point that will help you understand the consistency of the fund. So let me give you an example. Let's say if I talk about a particular fund having a rolling returns for 12%, what does that really mean is that let's say over the last 10 years, had I invested in this scheme at any point in time, provided that I would have just stayed invested for 3 years, I would have got 12% returns on the scheme. Now, when you look at this data point, you understand the consistency of the fund, because you are saying that I'm not deciding my entry date and my exit date. I'm saying over the last 10 years, had I invested at any point in time, right? Provided I would have just stayed invested for 3 years, right? I would have generated 12% return. That actually tells me the consistency of the fund.
Yeah.
And that is exactly what you should really look at versus looking at the last 3 years of return. You can also add one more data point to this, Pavitra, which is called alpha, right? So you look at, along with rolling returns, you look at alpha of a particular fund. And if the alpha of the particular fund is 0 or positive, that typically tells you that versus the risk that the fund actually took, it has generated, if the alpha is 0, it has generated exactly the same kind of returns that it was expected to generate. But if the alpha is positive 2, it says that the fund was expected to generate 12, but it generated 14. So when you club rolling returns and alpha together, I think you are getting the consistency of the fund, plus you are also understanding whether the fund has been able to do well versus the risk it took. So I think it's a very good combination to look at before picking funds, Pavitra.
I think that's very helpful, Kirtan. And, just looking at a few of these different criteria that you mentioned, it can help an investor make a very informed decision. So thank you very much for joining us for this quick take. I was, very interested by reading that article, and I decided to build this little episode based off of that. So thank you very much for joining us and taking us through this quick explainer. With that, we're going to wind down in this edition. I hope that helps all of our viewers. Stay tuned. We'll be back with more on the mutual fund space.